Since the last major real estate crash, speculation in the market has reportedly cooled thanks in part to government regulations and stricter industry standards. However, some believe a new bubble is forming in a different corner of the residential market: Airbnb properties. What started as a brilliant idea turning homes into mini hotels has nearly 16 years later transformed the market in a way that wasn't possible during the last crash. This trend has shifted the American dream, turning homes into cash machines for short-term travelers and large investors who often use obscure leverage through specialized loans and niche banking products. There's growing buzz in the industry that the Airbnb bubble is on the verge of bursting, with various pieces of evidence pointing in that direction. Since last year, rumors have circulated about declining revenues and panicked hosts. Data from AirDNA, popularized by Nick Gorelli, revealed alarming trends in the industry, but these concerns didn't gain much traction at the time. However, now the tides seem to be turning rapidly. Anecdotal evidence is piling up. Just take a look at the Airbnb host subreddit, where you'll find numerous posts with titles like "Anyone else notice that the market is extremely slow?" The comments paint a bleak picture, with hosts reporting significantly lower bookings and pointing to a myriad of issues affecting the short-term rental market: bad publicity surrounding Airbnb's customer experience, the impact of inflation on disposable income, and the simple fact that nearly everyone seems to be an Airbnb investor now have all contributed to an oversaturated market. Nick's most recent tweet provides solid evidence that this issue isn't just online chatter. The chart he shares reveals significant revenue declines in various cities across the nation. Leading the pack are Austin and Phoenix, each experiencing a staggering 47% year-over-year drop in revenue. This shocking figure suggests that the crash isn't just coming, it's already here, and the rest of the chart doesn't look much better. Cities like Myrtle Beach, Orlando, and Nashville are also seeing massive declines, indicating that this trend is widespread and affecting major markets nationwide. At the heart of this issue is consumer weakness. Consumer spending accounts for about 60 to 70% of GDP, and the short-term rental market, alongside with the hospitality industry, plays a significant role in this large portion of the economy. Right now, there's widespread concern about the health of the consumer, reflected in earnings reports across the board. Airbnb recently reported its earnings, and the stock plummeted 14% in a single day, the largest drop since the company went public in December of 2020. It's not just YouTubers raising alarms about this sector of the real estate market. Even billionaires and venture capitalists are voicing their concerns. In a recent clip from the All In podcast, they discuss some of these worrying trends, highlighting the potential impact on the broader market. Take a listen to some of this new concerning evidence.
I had lunch with a very prominent investor yesterday who's very plugged in with the hedge fund community. And he said that the sentiment shift, I'd say, again, within hedge funds, professional investors, public market investors, had been very sudden, that people were now very worried about the risk of a recession. And I do think that the Airbnb revenue that Shamath cited is a big factor. Airbnb's stock went down 15% in one day on soft demand. And what's driving all of this is consumer weakness, or at least fear of consumer weakness. You mentioned the rise in unemployment. It went from 4.1 to 4.3% month over month. So 4.3 is still a pretty low number by historical terms, but to jump so much in 1 month, that's a pretty big increase. And then, of course, it's up from 3.5% a year ago. So we're seeing pretty big increases in unemployment.
10% year over year, 5% month over month is very significant.
Yeah. So these are big changes. There's real evidence of consumer weakness. And I think professional investors are getting quite worried about the risk of a recession. And I guess just one last point on this is that if you were to remove the impact of government spending, it's pretty clear the private sector is in a recession. I mean, like we've been talking about, government's been going hog wild with spending. The government is running 6% of GDP deficits. The latest Q2 growth number was something like 2%. So if you force government to live within its means and to cut its way back to balance, we would definitely be in a recession. We'd have a negative growth rate. I do think that the economy is looking pretty shaky all of a sudden. Whether we actually tip over into recession in the next few months, I'm not sure.
As you just heard, there's growing concern that Airbnb's impressive 4-year run might be coming to an end based on their most recent earnings call. We can dive into this call to find some concrete evidence straight from the company's executives. Keep in mind though that these individuals are paid to present the company in the best light possible, so the reality might be even worse than what they disclose. At least that's my non-professional opinion. One of the key points that spooked investors and led to the stock sell-off was the mention of shorter booking lead times. The actual quote reads, "We're seeing shorter booking lead times globally and some signs of slowing demand from US guests, and our Q3 outlook incorporates these recent trends. Shorter booking lead times could indicate that consumers are becoming more hesitant to commit to travel plans far in advance, possibly due to economic uncertainty or tighter budgets. This trend could result in unpredictable revenue streams and is often seen as a sign of weakening consumer confidence." Additionally, the call mentioned a shift in demand towards higher-end properties. They stated, "It sounds like people are choosing more expensive or larger properties, and I think part of the read-through from that can be, oh, people are choosing more expensive listings, therefore you are seeing stronger demand from higher economic demographics. While this suggests that luxury properties may still attract bookings, it also hints that the broader market, particularly among mid-range or budget consumers, could be under stress." This brings us to the broader discussion of whether the economy is as strong as it appears. Take unemployment, for example. While it's still relatively low at 4.3%, which is below the historical average of 5.75% dating back to 1948, employment data can be tricky. It also tends to be sticky, meaning that once unemployment starts trending upward, it often accelerates rapidly and only peaks during a recession, never before. If we take a look at this chart, going back to World War II, you'll notice that when the unemployment line begins to curve upward at a certain slope, it's typically followed by gray areas on the chart. These gray areas represent recessions. This pattern suggests that rising unemployment is almost always a precursor to economic downturns. This is why the SAM rule is such a reliable predictor of recessions, going back to 1950. It measures how quickly unemployment rates change, allowing it to accurately forecast most recessions before they occur. And right now, the SAM rule has been triggered, which is cause for concern. Adding to this, the Bureau of Labor Statistics has recently been revising employment figures downward at a record pace, further fueling worries. When you put all of this together, it's easy to understand why so many people are anxious about the current economic outlook. And you start to see why one of the first things we're seeing slow down is Airbnbs. There are currently over 1 million short-term rental properties in the United States by most measures. In comparison, there are about 500,000 regular homes for sale across the country. This means that even if a small percentage of the inventory held by short-term rental investors is sold during a downturn, it could put tremendous downwards pressure on the entire real estate market as inventories rise rapidly and supply becomes oversaturated. The epicenter to watch is in high revenue markets like Austin and Phoenix. If you're a short-term rental investor who used one of these specialty loan products to purchase homes, especially in the last 2 years at very high rates, you have to wonder if forced selling will occur. These are also the areas where we're already seeing an influx of inventory from the regular market, so it's very possible that over the next year, Airbnb properties could be a significant driving force behind price crashes in some of these cities, particularly if the recession rumors turn out to be true. While we haven't entered a recession yet, there is now pretty good evidence to raise some alarms, and you have to wonder what is going to happen to these supply levels once the market makes a turn for the worst. Let me know what you think in the comments below, and if you're an Airbnb host yourself, I would love to hear what you're experiencing on the ground right now. Are these revenue declines true, or are they really just rumors across the internet? And while you're at it, if you're an investor or hoping to become one, I would love for you to check out foreclosure.com. Foreclosure.com stands as the premier resource for distressed homes for sale in the United States, offering a vast repository of over 1.8 million listings encompassing foreclosures, pre-foreclosures, bankruptcies, tax liens, and other distressed assets. If you're looking for an amazing deal as a professional, please give this amazing website a chance. You can get a free week by using my affiliate code found in the description. Thank you guys for watching, and please make sure you hit that like and subscribe button if you enjoyed it.